podcast and YouTube blog covering the German startup scene with news, interviews, and live events.
Hello and welcome everybody and Happy New Year. It's the 19th of January 2023 and this is our first interview, our first piece for this year. I'd like to welcome I may say steady guest, unofficial member of Startuprad.io, Paolo. Hey Paolo, how you doing?
I'm fine, thank you, and buon anno a tutti. Happy New Year.
Happy New Year. As people can already tell, you are Italian, but our frequent listeners will know that you're based in Frankfurt. You have been there an entrepreneur, set up a company. We'll soon get a little bit into that. The company was bought up by IBM, and ever since you are based there for IBM with changing titles, but you basically did the same. Your official title is, as we established before the interview, now for 3 years, the global research leader in banking and financial markets for IBM Consulting. And of course, you're also a best-selling author. I was wondering, did you already make it to the New York Times bestseller list?
That's a very good question. And now, you may know well that banking books sell a lot when they talk about misbehavior of banks. I actually have the tendency of explaining how banks can behave good. Bad sells more than good, but this one has been selling very well because Banks and Fintech on Platform Economies, which is my fifth book and bestseller, has been a number one or consistently within the number 5 top selling books on Amazon in the banking category over the last year. So definitely a book that resonated well worldwide, not only within the fintech community, so people that want to promote change, but also at the highest level of CEOs of financial institutions reading the material and reaching out with comments. So that was very flattering to see that effectively the audience received this content with the right enthusiastic tone.
Mm-hmm. Actually, we also know that we are also heard and seen, because this is not only an audio podcast, this is not only an internet radio, but also a YouTube blog. Basically, we do run one recording and we use it for all of them. And we know our audience has a lot of decision makers, has a lot of investors, has a lot of entrepreneurs and founders across the world. Actually, at any given month, we are scoring in at least 25 podcast charts across the world. Right now, I would like to welcome the people from Ghana, Tunisia, and Egypt who have apparently not appeared on a podcast charts list before. Welcome, guys. I've hinted you have been a fintech entrepreneur yourself. Can you tell us a little bit what you did before you got your most recent job?
So that is actually the reason why I moved to Germany in 2008. Before I was leading quantitative risk management departments in capital markets and investment banking. And then after making so much innovation in terms of financial innovation, I thought it was time to take care of the small clients, so the retail clients, transforming the way they access financial services. And I moved to Germany to create a startup that was focusing on digital wealth management. So basically, how to create new engines to transform the conversation between the institution and the final client based on, if you like, better perspectives and more transparent conversations. And this small company, when I had 22 people in the payroll, a few clients, was bought by IBM in 2012, end of 2012. And that's when I joined IBM. So for the last 10 years, I've been working in IBM. And IBM said we actually look for thought leaders, so people that can basically make an interpretation of the industry trends. Would you like to do that? And I remember I was in New York in 2013, and I said, "What's a thought leader?" And they said, "Well, the head of consulting at the time, well, is somebody that has a good reputation and can write blogs." And I said, "Here, this one." Right. I am Italian. I'm 40 years old. What is a blog? And so then I had to learn about the social media practice because I was not on social media at that time. And so I said, can I write books? And I said, I want to write on fintech because I think this is a super important topic for everyone, not just entrepreneurs, but also institutions. And that's where I started. But my literature, which is intersecting my role at IBM at the different investigation domains, from quant finance again to digital wealth management, till the last one, which is really foundational for everyone, is banks and fintech on platform economies, which designs the structure of the transformation of the business models in the industry going forward, looking at the intersection between information, data, and communication, people and relationships. It will be presented in a few weeks to the European Commission, for example. I use it for my contribution to the European Supervisory Digital Finance Academy that takes place in Florence for the education of the executives of the European authorities. Just to give an example, it goes beyond Europe. So it's very important for regulators, for bankers, for startup entrepreneurs to understand what did not go well in the last 10 years and how to make sure that we generate value for everyone in the ecosystem going forward.
I see. And Florence is pretty beautiful. So you are a person who sees the long-term trends. That's why you are here. That's why we look a little bit into the glass bowl for the future. But first, let us take a tiny look back, because we hopefully almost over the Corona global pandemic, at least in some countries. In others, it's looking like it's getting really bad right now. Do you see a specific impact there? Because in Germany, what everybody has in mind is that was the time cash went out of favor and you started to pay cashless, even just by touching the credit cards. Do you see like any big trends coming from that besides that?
Well, I would say that Germany is still kind of a cash society compared to other societies in the world. But a little comment before we dive into the impact of the pandemic. You mentioned long-term trends. Now, it is not my habit to talk about flying cars. Maybe there will be flying cars, maybe not. What I prefer to discuss are the conditions upon which a certain future can be realized. So we always try to connect here what we see in the present or what something that just happened to infer basically how this is modifying the next step and then create a journey towards a future when value is generated. But the future doesn't happen by itself. It's made of actions that we take. So I'm trying to anchor those actions to the creation of value, right, for clients and for stakeholders. You go.
I heard once a quote that forecasts are very difficult, especially concerning the future.
Well, all of my literature, which is based on my theory and principles of financial market transparency, is about the fact that the future is open, which is a huge problem in banking and financial markets because the industry tends to sell predictions which cannot be sold. And that creates as consequences in the relationship with clients. When digital takes over, there's no relationship that sets those predictions, which should be regulated to avoid FOMO. And therefore, the mechanics are impacted. So the real problem here for startup entrepreneurs to generate value is that they need to understand digital, mobile is a technology of demand when people more or less know what they want to look at. But most of the revenues that matter in banking are operated as an offer delivery industry because we need to deal with the uncertainty of the future, and therefore the industry creates narratives which are positioned through conversations. And when you eliminate the conversation, technology, if it is demand-driven, cannot support it. So there are techniques that can be applied to mitigate that, but first and foremost, we need to re-understand without romance the way clients make financial decisions, which differ from the way they make e-commerce decisions and blah, blah, blah. So all of this is part of my literature.
Sorry, Paolo, when you talk about the romance, you refer to the time when you had a banker in a suit and a tie and a white button-down shirt, and he was sitting in a grandiose office, and the wealthy people walked in and talked for a few hours, and then they went back and left a lot of money at the bank, right? That is what you refer to.
When I talk about romance, I also think about a venture capitalist that doesn't wear a tie but pretends to understand how the future is shaped, creating a hype for the valuation of a company. So that is still romance, okay? So it's telling us stories that don't exist. It's like the old discussion about the intergenerational change. Yes, people might have different ways of accessing technology, but they're all exposed to fundamental uncertainty when it comes to finance because this is not e-commerce. And basically the way we position in front of that, if we eliminate fear of missing out, which should not be used because it doesn't comply with fiduciary standard, is very similar whether you're young or you're old. And understanding that enables you to learn how to onboard clients on your platform that are not just there because it's cheap, it's free, but are there to do something to reward you for your effort and investments by paying access to that platform. And that generates an economic model that makes sense beyond the venture capitalist volume expectation. So the problem of the industry today is that some volume can be generated, not in all fintech corners, but that volume needs to lead into an economic reward for the institutions so that they can continue plug in investments to pay for salaries and to create innovation. And if that is not resolved, the initial very risky capital would dry up and a lot of time is wasted. Now, I understand that it is a venture capitalist mantra to say we try here and there and something will pop up. And I'm like, well, I prefer to advise the entrepreneurs how they can be that one that can make it happen, right? So they should not rely upon the chance of being the one that can basically succeed them. So it's a different approach.
What you refer to is, I do believe, referred to in venture capital as spray and pray approach. By the way, you talked about volume, so you totally think that fintech is and will remain a volume business just due to the way it is set up?
No, I believe that it can focus on value. And we might be deviating a bit, but I remember when I opened the IBM office in Shanghai with a presentation of my previous book, Fintech Innovation, that was in 2017. And there I had a discussion with the audience about the difference between volume and value. And that's when the board of the most digital bank among the urban banks of China reached out for a conversation that led into a joint work that was published in Chinese named Panoramic Banking, which is a precursor of some of the content of my banks and fintech platform economies, as wanted to answer the question, how can a bank compete with the tech giants like Alibaba or Tencent owning WeChat, because they already have volume. They don't even have super volume. They have uber volume. Okay. So now they understood that basically they were wrong in thinking the platform strategy was to target volume competition, volume-based competition, so that to redefine value instead in order to compete. Right. So it's different perspective between convenience and the generation of value. And so that led to interesting conversations about how to change strategy for engaging with the ecosystem around the platform interplay. And therefore, understanding this difference is important. However, volume is easy to be understood. Value requires an axiology, a theory of value. So if you do not define value, you cannot digitize it. And so my effort in literature in the last few years has been around identifying the definition of value for clients that enables them to appreciate and reward the investment made to build a relationship that digital needs to support, because it's very difficult to demonstrate that value in a noisy world without being supported by technology as well. But it's a completely different way of looking at the role of technology inside a refreshed business model that targets this new value or this hidden value. But, I believe the audience will want to read the book to learn more about it. We'll provide some insights later on in the conversation.
Yes, totally. Because may I get a few hints about those values you can see the fintechs can generate for clients? Because that's not only approach the banks can use against big tech. As you said, they have uber volume. They're already really, really big. And so they could make money just on the volume of business there. But when a fintech now starts up, I've heard they still do that. What would be some of those values they could target to deliver in order to survive between the big banks, the smaller banks, the established fintechs, and the big tech?
Okay, there's an important concept that lays ground to the understanding of value, which is a biological perspective on how we make financial decisions. So that framework is the bank and invention quadrant, which has two axes. one axis is information and one is communication. It is through information and communication that businesses are created in financial services to engage clients. Information is typically the more symmetrical part of the banking business and is about volume because it's payments, is the credit function, therefore the appraisal of the credit risk scoring and the appetite of the bank. And that is where, if you like, there is the typical play of the institutions with a lot of data, a lot of financial information. But that is also where the problem, especially for the entrepreneurs in Europe and the bankers in Europe, occurs because the net interest margin has been very, very poor because payments are very competitive here. So the margins are much lower than in other constituencies. So it's difficult to extract value because volumes needs to grow much faster than the reduction of the interest rate margins. Even today, given the fact that the interest rate might be raised, some bankers are expecting to be better off because they can price up more on the existing volumes. The problem is that that happens within the year, but if you think about the potential recession, that will fire back in terms of the deterioration of the credit quality of your portfolio, so the expectation of more non-performing loans. So it's a very complex landscape. So now, if you want to operate there at the volume, okay, you really need to understand how to leverage payments, right, with the outside of the banking ecosystem to capture much bigger volumes and most likely to generate a different value that is not there in the transaction. So volume is typically about a price you tag to each transaction. But as the price goes down and down, the transaction can be limited in your banking environment. You move out of that one. You use that banking capability or open banking capability with a fintech to eliminate the friction in an external ecosystem. And you allow that ecosystem to create new value on the interplay of individuals, of companies, of corporate. And therefore you try to grab that value, which is the value of accessing a non-banking platform where banking is there to eliminate the friction. So the balance between the transaction revenue and the non-transaction revenue is in favor of the non-transaction revenue. But of course, right, there are some elements that participate into the whole chain that are shared among the parties. But so banks are now learning that they need to be orchestrators of those ecosystems to grab that new value, or they need to be, if you like, participants in a way that they know how to grab that value. Right. So that really means resolving the business problem of clients, which is not finance. Finance is not the problem. It's always an enabler. Right. So it's not finance. It is solving the business problem or the personal problem. And then you have the other type of value that, but you have a question, goes in the direction of communication. So the other axis of the quadrant.
Yes, where to start and where to stop. First, for everybody who doesn't have a finance background, the interest rate margin is just, to make it very simple, you give me money, I give you 1%, I lend it out the credit for 8%. Between 1% and 8%, there's 7%, and that is the interest rate margin.
Yes, so basically when the interest rate is high, so you can add the spread on top. That is the money you make with the client. So the coupon you pay when you have a mortgage, right? All of the payments you make. When the interest rate is low, also the spread on top of the interest rates is lower. So the bank will get less money from you. So you know that you have zero interest rates, your mortgage is cheaper. If you have 5% interest rates, your mortgage is higher, more expensive for you. And that corresponds to more money they get into the bank. But then the bank has to use that money to remunerate the variety of things, right? So the other side of the game, because they take money and they need to reward the money as well that they lend to somebody, or the credit risk, right? Because the healthier economy, the lower the credit risk, but the recession economy implies defaults, which unfortunately occur because not everybody can make it in their business life, and that might impact basically the healthier performance of financial institutions and actually create more problems. So all of these intricacies are at play today in a very different way compared to the world that we were used to live in before the global financial crisis. I know that a lot of your audience, Jörn, is very young. I'm 52 years old. So, but before 2007, the world was basically different. The business world for the good and also for the bad in many cases. And that's the reason why when Mario Draghi, the former chairman of president of the European Central Bank, left office in 2019, that's why he said to the audience of journalists answering a question if these new macroeconomic conditions would create the next financial crisis. He said that, well, I know that banks would love positive rates and blah, 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 but basically said that the complexities of the macroeconomic condition will stay. So what needs to happen is that banks need to adjust the business model to the digitalization of financial services. And when central bankers talk, words matter. He didn't say they need to digitize existing business models. He said they need to adjust the business models to the digitalization. So fintech entrepreneurs need to understand that clearly, because if they pretend to use digital just to digitize an existing model, creating, for example, a marketplace for products, they will not succeed. The problem of the new banks, for example, they are not understanding how to grab more value because they're not generating more value on digital for clients, so they cannot be remunerated for that. So they need to understand what implies a transformation of the business model. But now, if you do not know what is the distance between people and their decisions when it comes to human-related traditional banking, you will not understand what you need to do to adjust the business model in a way that technology that is not a perfect fit for that gap reduction, what technology has to do in order to make it happen. So it's not easy. It's a bit tricky, but it's foundational and it can be understood, because once you spend some time studying, you get the points right. And so that it can consequentially act. Okay. And that is basically my role, to help you basically see all of these elements which are out there, right? You just have to look at them with the right perspective.
What I've taken from your awesome wrap up here with an adorable Italian accent is, I would define value as make it easier, cheaper, or more convenient for clients to do something that they've done before. Maybe they completely redo something, but they have to have something from it. There's a benefit, the value you're talking about, right?
Yes and no. Convenience is about information. It's not about communication, which is another axis for value. And as I said, convenience is a race to zero prices. So at some point, you will not be able to price that convenience anymore. It's like you had to, go to the post office when you wanted to buy something on Amazon, and now you pay for one click. At some point, you assume that you're not paying for that. It's part of whatever price, and the price is very competitive, so it becomes zero price. And you assume you need to be able to pay that way, right? Because it's your habit. So that commoditizes very fast. Convenience commoditizes very fast. And that's the reason why convenience enables you to interact differently with others. And the value is about the need to interact with people. And therefore, the value is in accessing the platform, is not in the convenience of the individual pieces, which get commoditized and sooner or later insourced on the platform by the platform orchestrator. So that you need to be ready to understand that convenience is just an initial step for the generation of value, but the final value that will stabilize your business model is outside the individual convenient transactions. And when I discuss the contextual banking platform strategy in the banks and fintech on platform economies, I therefore refer to the shift towards being capable of motivating users to pay for access that contextualized banking platform. Then there would be a completely different play when you look at the conscious banking platform strategy, which is also defined in the book, which is about more complex decision-making processes where the value is inside the relationship and needs to be revealed by technology. And it's a different way of creating that value. But ultimately, it's always about recognizing that the monetization shift out of products, out of transactions, into the outcomes, into the relationships, differently played between information intensity, contextual banking, or communication intensity, conscious banking, which typically goes around planning, wealth management, insurance, done also for the masses, not just for the ultra high net worth individuals.
That is a very important statement, I do believe, that I've taken its focus on the outcome, not on the transaction, not making it convenient, but helping to achieve their goals, whatever that might be.
Oh, yes. So the shift, the foundational shift on platform economies that characterizes a big part of the fourth industrial revolution, which is a platform revolution, is a shift from outputs to outcomes. And we need to clearly define that, otherwise we get mistaken. But that really explains why experience is important, being a key component of the engagement model. But without understanding the shift of monetization from output, out of products, into outcomes, which is relationships, is not possible to plug in technology the right way to be basically rewarded for the investments in a sustainable way.
Also, Paolo, you talked about bank being the orchestrator in such a platform, in such a network. Can you already give some pretty good examples where the banks are really good in orchestrating that? Because that would pretty much mean you have, like, for me, my picture is right now, you have one bank in the center and you have a lot of fintechs, tech companies, and other entities around it. And the banks help to get it to get the flow smooth there.
Okay, so there would be two very different examples. I mentioned for information and communication, I mentioned value, new value generated out of volume, and then I mentioned hidden value, which is revealed inside of the relationships. And now I tell you, when you think about the contextual banking platform strategies, which are more around the intensification of the information quotient, you can think about an agri-farm business where there are banks out there which are also trying to help the communities of farmers in their constituencies to interact the one with the other differently, starting, for example, from weather forecast using, in our case, the weather channel of IBM, which is the one you have on your iPhone, is powered by IBM, in order to basically decide on which crop basically to focus on, given the global climate conditions. But then delves into how they can sell basically their harvest and how they can be paid and how they can lease the machinery and so on and so forth. But you see, those are buy-side opportunities of a platform which is centered in smoothing the supply chain, the interactions among economic actors for a certain business or a variety of different businesses. So now this can be generated by a non-bank, but there are now banks that want to be in that game, creating on the side an orchestration of those ecosystem platforms, so platforms that basically operate at the level of making an ecosystem functioning with digital in better terms. On the other side, you have banks which are now focusing on enriching the advisory relationship with clients, recognizing that, think about the US, you can now access an ETF investment for zero embedded fees. And if you don't have an embedded fee, you cannot remunerate the linear value chain that goes from the manufacturer to the distributor, right? And there is a reason why, for example, when I've been keynoting for BlackRock, opening some of their key conferences before the pandemic, and I crossed Larry Fink at the main stage of Morningstar in Chicago in 2017. And I remember Larry Fink, the CEO of BlackRock, which is the largest manufacturer of investment products in the world, saying that he wanted 10 years, 7 to 10 years from then, 2017 speech, 30% of his revenues not to come from products, but solutions. What he meant is that the products, the transactions are in a race to zero prices. So the value will be positioned at the level of the relationship between the bank, the advisor, and the client. There needs technology to be orchestrated and to scale, because you need to go beyond the number of limit, the number of clients you can manage in an individual relationship. So those guys are understanding this element as well. So now what happens is that somebody can also orchestrate that advisory platform. So the advisor is a network of individuals that require support by technology to basically give a shape to the conversation with the clients in a way that they're not inside the prediction of products, but they're inside the resolution of the needs of individuals. So it's a planning perspective, it's a goal-based wealth management or a goal-based investing, basically conversation. And there you see again that as on a platform, you need to have the whole life of an individual using also information with more completeness. You have two elements that are part of a banking business model. One is the liabilities, that means the mortgages, the loans, right? Liabilities of families and corporate. Mm-hmm. And on the other side, you have the investment opportunities or the insurance needs. Now, most of these products on the asset side commoditize. So you cannot personalize on those. That's another mistake of the fintech entrepreneurs focusing on personalization around assets, products, which are all basically highly correlated. Think about the tech stocks. Most of them went down the same way in the last year. So stories, correlation. Now, the personalization occurs always when you look at the liabilities of individuals, because you have two children, I have none, right? And so on and so forth. So now what happens is that by seeing the client holistically inside the institution, not anymore siloed inside different business units, you can create incentives so that beyond the pricing of credit risk, market risk, which you have to do anyway separately, you come up with an understanding on how clients can pay for accessing that advisory platform. And so the role of the bank being capable of using technology and investing in technology is allow a variety of individuals that by themselves cannot do that to have a mean to reach out to their customers in a way that they can demonstrate the value of that open and transparent relationship. And there are banks which are basically doing that. You can think about the role of UBS or Morgan Stanley. Now they're not down the line to me in terms of doing it all as it should be done. Okay, so there are still gaps between what I see and what they've been doing, but I see that they're moving in that direction to be orchestrators of planning and advisory platforms.
Mm-hmm. I see. That also means the investment approach some VCs right now have in terms of fintech is very much focused on products. And you, if I understand you right, that may be the wrong approach for long-term success of the companies.
Well, yes. I would also say, when I was an entrepreneur myself, I was more a scale up than a startup in intentions. Okay. Mm-hmm. So the venture capitalist might want to, get the bank, and then you can sell to somebody else, get somebody else in, so they get their reward anyway. Okay. All the way through. Mm-hmm. The thing instead is to have a long-term investing perspective. So you need to ask yourself how that company evolves beyond the initial hype, right? Or the narrative around your startup evaluation, which is a different story that I find way more interesting. Now, understanding how you evolve out of the initial simple-minded effort, because no startup can start basically orchestrating the whole ecosystem, right? Mm-hmm. So very few can do that. Is to me important because understand if they have already defined in their business logic the limits of the initial proposition, and therefore they know that they will have to remediate it somehow along the way with partnership or with different investments. So they have a clear understanding of that. If they don't have that, they fall into the romance of the individual product. Some cases can, work, but very, very few cases. And then typically those cases that work are repositioned inside through an M&A prospect somewhere else. And if they don't have the understanding, those somewhere else of what the framework is, a lot of these start losing value, right? We saw that very often in business life. So what I try to do is to make sure that we connect and we anchor the long term and the short term with clear perspective, so that we know how to save the good, so the baby, when some of the dirty water is thrown out, because not all investments will be able to resonate, right, and to remunerate risk capital.
I do believe we want to talk about 2023, but we have an outlook very long term, how banks and fintechs will work together, will compete with with each other on a very high level. When people are now listening to this, and I do believe a few have to re-listen, I also have to re-listen to get like all the value out of that. What would be like 2 or 3 sentences that people should take with them in order to prepare for the next few years? If I've heard it correctly, that are forces that will be playing out for the next 5 to 10 years, because the structure is not so easily adjustable. Plus, we have a potential recession on the horizon here.
Okay, so we just released as IBM the 2023 Global Outlook for Banking and Financial Markets. So this question comes at hand conveniently. And this is actually a report that I believe you will enjoy reading. That is about the economic model of financial institutions, intersecting, of course, fintech innovation around the need to basically grow and perform in uncertain times. Uncertain times can also be an opportunity moment. About the cost and efficiency, because operations are too expensive given the contractual margins, which is a longer trend, right, or a medium-term trend that is happening everywhere, and at the same time remain compliant, especially considering the new risks that the cloud economy or the cyber economy is generating. So first of all, I would say 3 takeaways that matter in this conversation of startup entrepreneurship. There has to be a better link between business and technology. What I saw in many banks and also in the startup ecosystem is a hype around technology that therefore looks for use cases to apply technology, while it is always about defining the problem you want to solve and then look for the technology that makes sense at that point in time. But sometimes the investor scene is flipped. Okay, it's the buzzword on the technology piece, and then the use case is, if you like, in the background, and then maybe technology is not at the level of maturity yet, or the use case is not appropriate, and it doesn't work out well. But in the meantime, we generate a lot of noise, right? A lot of dust. So to me, it's important to rebalance this relationship. I said before, adjust the business model to the digitalization of financial services. So the intentions needs to be right. Okay. And business and technology in this case are co-equal in making that adjustment, because I need to understand the pros and cons, right? And the engineering pieces around those adjustment elements. The second, which is also important, we are moving steadily into the 4th industrial revolution, which is a data revolution. That means a platform revolution. Now, that requires a higher level of openness in corporate life from the way we work and the product and solutions we deliver to customers and clients. But that level of openness can only be fruitful and convenient in making when we are grounding our technology infrastructure on solid public cloud foundations, which is about the techniques by which we can innovate anywhere and everywhere, thinking about the application management and the application creation. So you need to build once, in essence, right? You cannot invent the wheel every time. You reposition your analytical piece, and you need to be capable of managing that on different platforms for different purposes. You can think about it this way. There was a time where technology was about computers. Mm-hmm. Now it is still about computers. Like, I love my MacBook, but in essence, I remember I visited the HR center of the Banca d'Italia in Rome, just outside Rome. Is for HR. There is a huge building with very tall ceiling, because that was created in the 1970s to host the computing operations, where at the time computers were bigger and bigger and bigger, right? So now we're not in the hardware world themselves. Hardware is very important, right? But technology moved, and it moved in the 80s into software. And software is a very well-defined industry-specific domain with an interface where basically you try to engage users that want to do something, right, for their personal or their business life. But in the last years, we're now moving into analytics. Analytics is basically the capability of sharing information across platforms, across software pieces. So everything opens up. So you need to understand clearly how to operate on hybrid cloud on a variety of different environments where the techniques of making the job done are important. Otherwise, you start up your company, your bank, your new bank, your startup, and then you don't know how to blur the line. I said before, it's not your initial product. Immediately know that will not be sufficient. So everything you create to create that first product or solution needs to be capable of transforming, being flexible to generate something else. So you can call it cloud native if you like the cloud world or whatever is about the techniques and the way of working. And this is now, this realization is happening now in banking as well. I think that after the first years and after the pandemic of like hyperscaling access on cloud, they realize that the connecting point between the infrastructure and the way of working, that is the people, right, is always a secret sauce in everything. And the third and the last is connected to this one. We said that the business model will be adjusted for the digitalization of financial services. The digitalization needs to occur basically on different ways of working, leveraging an hybrid cloud perspective. But we all know that a world that is becoming more interconnected and if you like more open is also a world where new weaknesses will be exposed that could be exploited by rogue actors. We are in unfortunate years of conflicts with the war in Ukraine. We are all concerned about potential cyber attacks that are now involving possibly not just rogue actors but also government. So there will be generated and maybe performed at a different scale. So maybe the next systemic crisis will not be a financial crisis like the one we had in 2007. That was about financial innovation, quantitative finance. So maybe the next systemic crisis will be operational. And when it's operation, it's about technology. So 2023, sitting on 2022 is the year where the cybersecurity aspect and the resiliency aspect of the industry came to the forefront, not just because of regulation like the DORA regulation in Europe, but because of business, government, strategic industry realization. And when it comes to cybersecurity, then you make quantum leap into the future, to say that. So now this is also the quantum advantage decade. So where we believe that quantum will demonstrate an advantage as an integrated or a complementary computing platform on traditional computing. Now we know that quantum computing might be capable of encrypting existing security algorithms. So a lot of investment are now directed into quantum safe cryptography. And you need to take care of that now, because everything that you're storing today can be exposed to manipulation in the future when new technology arrives, right? So you need to prepare for that moment. And in a sense that 2023 will be the year where this will be more considered, shaping the way the industry will protect itself and infrastructure going forward, which is for everybody's benefit, but is also relevant for the individual fintech. They typically exhibit a higher level of openness compared to traditional banking, and they can't be exposed to cyber resilience or cyber attacks.
Mm-hmm. Whew. Paolo, I do believe that was quite a tough load on information people have to think about and have to dissect right now. But basically, what they get here free of charge is information, is quality you usually only get, as he said, when you do keynote for BlackRock for one of their flagship events. So that is pretty good, and exclusively on Startup Radio. We will link down here in the show notes the report you mentioned, the IBM report that is going to go live the same day. Cut us some slack here. So basically, there will be some mismatch during the course of the day, but the day after publication, we'll have it in the show notes in our Medium blog. Paolo, We planned this a little bit differently, but I really loved how this turned out. Love your outfit. Love your accent. Hope to have you back very, very soon.
The future is open, so is the Startup Radio episode.
The future is open. Totally fine. Thank you very much. It was a pleasure talking to you.
Arrivederci.
That's all, folks. Find more news, streams, events, and interviews at www.startuprad.io. Remember, sharing is caring.